When I first looked at the rule for taxation of Social Security, I said, they must be joking. I've been learning a lot lately about retirement benefits. I figured Social Security would be a tax-free benefit. And it was from the first payment made in 1940 until about 1984. But that changed, and the new rule on first read made me want to pull my hair out. First, let me clarify, I'm not an accountant or tax attorney. I'm an ordinary consumer just like you. I'm researching these issues because they affect me, and I figured I'd share what I've learned in these videos. But please think of me as a neighbor sharing what he's learned over the kitchen table. For specific information, please see a financial professional. So let's do three things in this video. First, let's look at the text of the rule and how it applies. Second, let's look at the history of taxation and why the numbers and categories are included in this rule. And third, let's explore briefly why this may matter in planning your retirement income. Here's the rule. All of your ordinary income and then half, and I'm not making this up, half of your Social Security income are added together. For a single taxpayer, if this total is less than $25,000, you pay no federal tax. If it's $25,000 to $34,000, you pay tax on 50% of your benefit income or AGI over $25,000. And if it's $34,000, you pay tax on 85% of your benefit income or AGI in excess of $34,000. Those relevant numbers, $25,000 and $34,000 for singles, are $32,000 and $44,000 for people married filing jointly. So the good news, I suppose, is that no matter what, 15% of your Social Security benefit will not be subject to federal taxation. And you don't pay 50% or 85% of your benefit in tax. You merely take that much, add it to your income, and then you crank it through the meat grinder of your usual tax filing. You pay your usual tax rate on that reduced Social Security income amount. There are some simple tax calculators online that you can use to play around with these concepts, like the one at covisum.com that I'll include in the description below. The IRS also gives you a pretty fancy worksheet that you can use, but I find it a little bit too complex. You can get the basic concepts from the online calculator. So, where did these weird numbers come from? There is a historical basis, and it comes with a bit of a twist. Your Social Security contribution from your paycheck while you were working all those years was paid in after-tax dollars, so it makes sense that the payout should be tax-free. And that was the approach for 54 years. But in 1984, under President Reagan, Congress decided that since most workers pay only half of the Social Security contribution, and their employer pays the other half in pre-tax dollars, then 50% of the Social Security benefit should be taxed. And that's the rule they adopted, and it stood for 10 years. A maximum of 50% of the Social Security benefit could be taxed. Then, in 1994, looking for a bit more tax revenue, under President Bill Clinton, Congress decided that workers only contribute 15% of their eventual Social Security benefit in after-tax dollars, and all the rest is like interest in a retirement account and should be taxed. So they changed the rule so that a maximum of 85% of the Social Security benefit could be taxed. Now, this is a bit of a stealth tax increase. In 1984, only 8% of Social Security recipients paid tax on their benefits. But the $25,000 and $34,000 steps were not indexed to inflation. They've stayed the same. So by 1993, 20% of recipients paid tax, and in 2023, about 56% of retired Social Security recipients pay tax on their benefits. Well, thank you, Congress. I thought seniors were a political force, But looking at the Medicare mess and the taxation of Social Security, I'm beginning to conclude that's just not true. So let's take a quick look at how this plays out in real life. Using round figures and a single person in this example, if you had a Social Security benefit of $50,000 and no income, you would pay no federal tax. And how do you get a $50,000 benefit? Well, if you wait until you're 70 to take your benefit and you get the current maximum amount, it would be $54,000 a year. Now, it would be nice if the government looked at half of your Social Security benefit, then added your other income on top to calculate taxation, and that's what they do not. Actually, they look at your other income first and then put your half Social Security benefit on top. So the table is tilted in favor of taxation. This is a bit frustrating, but these are the policy decisions the government made in favor of increased tax revenues. And unfortunately, it's not going to change in my lifetime. Now, let's take a look at the same amount of income, but with a very different result. Imagine you have $25,000 of ordinary income and $25,000 of Social Security income. Instead of collapsing down the Social Security first, the government puts it on top of your ordinary income and taxes $7,475 of your Social Security income, resulting in a tax bill, and this is using last year's tax program and amounts, of $2,044. Now I think the planning implications are becoming more clear. Imagine in both prior scenarios, you added $10,000 in long-term capital gains, maybe cash in some stock, selling a mutual fund, or maybe selling a lot you've been holding for years. If your total income on your tax form is below about $44,000, you pay $0 capital gains tax. If your $50,000 income was solely Social Security, you would pay no capital gains tax. But if your income was that $25,000 split we talked about, your $10,000 capital gains would be taxable, and your tax liability using a 2022 tax program would go from about $2,000 to about $3,000, a $1,000 increase in your tax payment. Now you can see why this matters. I'm not yet taking Social Security, and I'm in the position where I plan to have some long-term capital gains coming up in the next year or two. So this taxation issue does make a difference to me. If I defer taking Social Security for a bit longer and suppress my income, I can hopefully get a zero or reduced capital gains tax rate. And everyone knows that tax-free income is the sweetest income. Initially, I thought I would do a long and comprehensive video about the tax floors, ceilings, and cliffs involved in retirement benefits. But because the issues are so complex and not every issue applies to every person, I've decided to make a series of shorter videos on this topic. Good luck in your retirement benefit planning, and thank you for watching.